What's up everybody, I'm Jaspreet Singh and this is interesting. A former Federal Reserve chief just came out public and said this: one thing is certain, to be effective, the Fed will have to inflict more losses on stock and bond investors than it has so far. Essentially what he's saying is that if the Fed wants to get serious about fighting inflation, they have to get much more aggressive. Now the previous rate hike of just 25 basis points, which is 0.25%, that brought mortgage rates up to 5%, and he's saying that that's not even close to enough to fighting inflation, and that the Fed should actually be working to crash the stock market in order to fight inflation. Now that's a big change of heart, especially when you look at just a couple years ago when the Federal Reserve Bank was willing to do anything at any cost to make sure that the stock market would not crash. The Federal Reserve Bank created unlimited quantitative easing and opened up the money printer. That way investors would feel comfortable investing in the stock market even though we were in the middle of the worst recession since the Great Depression. So what gives? How can you go from we must protect and save the stock market at all costs to now we must crash the stock market to save the economy? Turns out it's this little known concept that nobody in the Federal Reserve Bank thought would be a real problem, which is known as, well, inflation. Before, when we were first getting hit with the pandemic, it was all about saving the stock market and doing whatever you can, meaning print as much money as possible to keep the stock market from crashing, to get the stock market going. But now it is, how do we protect our economy and how do we save the dollar from this inflation crisis by reeling in the inflation? And the way you do that is by doing the opposite of what caused the inflation. What caused the inflation? Well, money printing. How do you save the dollar? Well, you no longer print money, but also you start getting rid of some of the money out there, meaning you start tightening the monetary supply. And so if a loose monetary supply and unlimited money being printed and injected into the stock market causes the stock market to rally, the opposite would cause the stock market to, well, go down. So money loosening causes economic stimulus, which causes inflation, but money tightening causes an economic contraction, which causes, or supposed to cause, deflation. The problem is not so easy because there's consequences to money tightening, such as the stock market going down. And I haven't really talked too much about the Fed balance sheet on this channel, so let's talk about the Fed's balance sheet. The Federal Reserve Bank, according to Investopedia, has three main things on their balance sheet. They have treasury bonds, which are loans from the government. They have mortgage-backed securities, and then they have something called other assets. We're going to get to other assets a little bit later, but that's also a very interesting part because one of those things is corporate bonds, because for the first time ever in 2020, the Federal Reserve Bank started buying up bonds from private corporations, meaning if you are a big company and you were struggling to raise money, the Federal Reserve Bank was just throwing money at you. Over the last couple of years since this whole pandemic started, the Federal Reserve Bank has spent trillions of dollars it doesn't have expanding their balance sheet. What that means is the Federal Reserve Bank had printed trillions of dollars to go out and buy these assets, either bonds from the government because the government wasn't able to raise money from anybody else, so the Federal Reserve Bank came in and threw money at the government, or they went out and bought these mortgage-backed securities, or they bought these corporate bonds and spent trillions of dollars doing that. And again, they didn't have these trillions of dollars, so they had to print these trillions of dollars out of thin air, which created more inflation. And now with the inflation problem as bad as it is, the Federal Reserve Bank wants to get a little bit more aggressive to fight inflation, which means not only do they want to start raising interest rates, but they want to start unloading some of these assets off of their balance sheet. That way the Fed can start reducing the size of the balance sheet. That way they can start shrinking the amount of inflation that we have. Now there's two things that I want you to be aware of when it comes to the Fed's balance sheet. The first thing that you got to be aware of is, as of the time of me recording this video, the Federal Reserve Bank balance sheet is still increasing, meaning they're still going out and buying some of these bonds. They're still spending more money than they have. And the reason why is because the Fed says they want to start reducing the size of the balance sheet in May. So throughout April, the Fed is still increasing the size of the balance sheet, but in May, they want to start selling off some of these assets and dumping them into the private markets. And the second thing that you want to be aware of is the Fed says that they want to dump something like $95 billion worth of these assets into the private markets starting in May. Now, $95 billion worth of assets entering the markets seems like a lot of money, but you also have to remember that when the Fed was growing their balance sheet, when they were trying to stimulate the economy, they were spending about $120 billion a month to grow their balance sheet. And now to reduce the size of the balance sheet, they're going to be reducing it by a smaller amount, which is $95 billion. This is one of the reasons why you've been seeing so much volatility in the stock market recently, because people are worried about what the Federal Reserve Bank is going to do. First, they said that they want to be more aggressive when it comes to increasing interest rates, which means it becomes more expensive to borrow money, which means it's more expensive for businesses to borrow money, which slows down the economy. And on the flip side, the Fed wants to start selling off some of these assets. So if the Fed is selling off these bonds at tens of billions of dollars a month, that means there's more bonds entering the markets, and if there's not enough people to buy them, that could cause the bond market to go down, which could affect the stock market. And I'm going to answer that, what that does, in just a second. But what that means for you practically right now is that it's more important than ever for you to be a financially educated and disciplined investor, because we're going to see a lot more volatility over the next 6 months and year. And you don't want to be one of those people that's trading or investing your money emotionally, because that means you're going to be the person that loses their money when you see things go down. Now, if you hit a point where you're just like, man, I wish I could have an expert investment manager to manage my money for me, well, then you should check out our sponsor, Titan. Now, I've done my research, and if you really want somebody who is a human analyst to help you manage your money and try to maximize your returns, then I recommend Titan. With everything going on in the world right now, this is a good time for you to consider diversifying and having a team in your corner of people that are looking at macro trends, what's going on in financial patterns and other world events. That way they can help you optimize your returns in your portfolio. Titan is an award-winning investment platform that's actively managed by experts, and is made not for the 1%, not for the 0.1%, but for everyday investors. The way it works is pretty simple. All you have to do is create an account, and then you can pick a portfolio. They have 3 different portfolios for equities, meaning stocks, and then they have 1 portfolio for cryptocurrency. Once you pick which portfolio you want, their expert analysts do the rest, and then you can track everything going on with your money right off of your app. Now, of course, investing has risks, but Titan's goal is to give you a 15% annual return on your money. And the best part of all is that you don't need a ton of money to start investing with Titan. You only need $100 to start investing with them, and because you are a Minority Mindset fan, they will also invest your money with 0 fees for the next 3 months if you use my link down in the description below, or if you go to titan.com/minoritymindset. So if you want to try them out with no fees and see how Titan can help you grow your portfolio, I'll put the link to how you can do that with our sponsor Titan down in the description below. So let's talk about what happens now when the Fed starts selling off their assets on their balance sheet. And remember, they have treasury bonds, they have mortgage-backed securities, and then they have the other assets. If the Fed starts selling off a whole bunch of treasury bonds, then treasury bonds become a less attractive place for you to store your money, because now you have a whole bunch of treasury bonds entering the market. So a lot more sellers than buyers, and if people are less attracted to buying these treasury bonds, and they're going to look for an alternative investment, and one of those might be the stock market. So kind of indirectly, the Fed selling treasury bonds, which sounds like a bad thing, because now they might be dumping these bonds, which makes bonds less attractive, which might make the dollar less attractive, but that actually might help the stock market, because people will be less inclined to go out and buy these treasury bonds if they're more of a risky investment. So while that might indirectly benefit stocks, it's not so good news for the dollar. Mortgage-backed securities are really interesting. Now, if you don't know by now, I am a real estate nerd, and the way mortgage-backed securities work, without getting overly complex, is if you go and get a loan that's backed by Fannie Mae and Freddie Mac, what that means is now you go and get a loan from a lender, and then Fannie Mae and Freddie Mac are going to ensure the lender, they're going to buy this loan from the lender. That way the lender doesn't have to worry about you potentially missing your payments, because now it's Fannie Mae and Freddie Mac's responsibility. So then Fannie Mae and Freddie Mac buy millions of these loans across the country, and they have all these loans sitting on their portfolio, and they don't want to just hold on to that either. So what they do is they start chopping up these loans, and they start packaging them, and then they start selling these loans off in the form of mortgage-backed securities. This is where now you'll see some institutions and maybe some investors go out and invest their money into these mortgage-backed securities to get some indirect exposure to the housing market. But then the Federal Reserve Bank will also come in and buy some of these mortgage-backed securities, just in case there's not enough private investors out there. So the Fed has come out and bought billions and billions of dollars worth of mortgage-backed securities to help support the housing market, to help encourage banks to keep lending their money, because if a bank lends their money out and no one's buying the loan from the bank, or if no one's buying the second tier down from the bank, then that's going to make it less attractive for a bank to want to go out and lend money, because banks don't want to have any risk, right? If a bank goes out and they lend money and now they have to hold on to all the risk, well then they are going to be much more picky on who they lend their money out to. And so this is why Fannie Mae and Freddie Mac were created as a way to insure the banks. That way the banks don't have to take on the risk. The risk falls to the full faith and credit of the United States government, which ultimately falls back to the taxpayer. So you, the taxpayer, take on the risk that the banks take. But now the banks don't want to take this risk. And so you have Fannie Mae and Freddie Mac that buy these loans from the bank, and then they turn around and sell these loans in the form of mortgage-backed securities, which are then bought by the Federal Reserve Bank, who doesn't have any money, and they get this money by printing money. So the Fed prints money, which means you pay the price of it through inflation. They go out and buy these mortgage-backed securities, which allow the banks to go out and make riskier loans, not like 2008, but riskier than what they would if they had to take on all the risk. And so now the taxpayers ultimately bearing the burden of the risk of the bank. And so if now the Fed starts to dump these mortgage-backed securities, well, that means these mortgage-backed security loans could potentially become less attractive, which means that banks may be forced to take on a little bit more risk because you have less buyers of these mortgage bonds. And that could change the way that banks potentially lend their money in the coming year. So there's a lot of hypotheticals as to what this could cause, because on one hand, if these bond investments become less attractive, then people want to move their money into stocks. But on the other hand, if these bond investments don't look good, it could scare stock market investors and force them to sell. This is why I said that you can expect a lot of volatility in the stock market, at least through 2022, if not longer, because there's a lot of uncertainty as to what's going to happen with these things as the Fed starts now unloading these assets off their balance sheet. Remember, the reason why the Fed printed trillions of dollars to buy all of these assets was because nobody was in the market to buy them, and it could cause an economic collapse. And so now that they hope that there's buyers out there to buy these things, they're willing to unload them, but this also depends on private buyers being in the market to buy these bonds. Otherwise, you could create another sort of financial crisis if there's not enough people to buy these bonds. And then we have the other assets that the Federal Reserve Bank holds on to. And the most questionable one that we saw happen in 2020 was when the Fed started buying these corporate bond ETFs. Now, this can seem a little bit confusing, but what that means is if you're a big corporation, let's just give some hypothetical companies, something like McDonald's. Now, one way that you can raise money if you're McDonald's is you sell more stock of your company. So you are a pie and you take a piece of the pie, you sell a piece of the company out in the stock market, and if you need more money, you could sell more ownership in the company to the stock market or to investors. That way now you have some more cash in your hand. The other way that you can raise money if you don't sell off some of the company is you go out and get a loan. Now, one way that McDonald's can go and get a loan is they go to the bank and they can borrow money from the bank. But what if the bank doesn't have enough money to give all this money that they need? So if you need billions and billions of dollars, then maybe a bank is not going to have all that cash. Well, then what McDonald's could potentially do is they issue a bond, a loan. So these are corporate bonds, right? A corporation, McDonald's, now is issuing a bond. And what happens now if nobody is there to buy these bonds? Well, then that could really hurt the company, because if McDonald's really needs the money to continue paying their bills, then that could force them to start liquidating assets. It could really hurt the stock price. It could hurt the economy. It could hurt the job market. And that's where the Fed in 2020 came out and they started buying these corporate bond funds, meaning they started buying billions and billions of dollars worth of these bonds by private companies. This is where it got really questionable, because how does the Fed choose which funds to buy, which corporations to support, and which corporations not to support? Because now, what if you're a small business? You don't get the same benefit as these big businesses have. And if we're supposed to be a free market, how can some corporations get a better benefit from the Fed than other companies? You can see why it got really questionable. That's why the Fed actually started selling off these corporate bond funds in the second half of 2021, because it was a pretty questionable move. It was the first time that we've ever seen the Federal Reserve Bank do that, because before, the Fed would only buy things like treasury bonds and maybe mortgage-backed securities, but never corporate bonds. So the plan right now is that starting in May, the Federal Reserve Bank is going to start unloading $95 billion worth of assets off of their balance sheet, even though when they were building up the balance sheet, they were buying about $120 billion worth of bonds every single month. But they want to sell trillions of dollars worth of assets. So over the next number of years, the Fed is expecting to unload trillions of dollars of these assets. Now again, what is this going to do? It's going to free up some cash, because the Fed didn't have cash to buy this $4 trillion worth of assets. They had to print this money. So in order to kind of undo all the money printing that they did. They need to start unloading that, and they need the private market to start absorbing this extra money. That's the first reason why the stock market is starting to get really worried about what's going on. The second reason has to do with interest rates. The Federal Reserve Bank already started raising interest rates. They started by making their first rate hike about 25 basis points, which is 0.25%. And they recently came out and said that their next rate hike is going to be even bigger and that you should expect many more rate hikes in 2022. What that means is that it is going to become more expensive for you to go out and borrow money to buy a home. It's going to become more expensive for you to carry credit card debt. It's going to become more expensive for businesses to go out and borrow money to build their business, and the government is going to have much larger payments on the $30 trillion worth of national debt, because a lot of the government's $30 trillion national debt is not a 30-year fixed rate mortgage. They are short-term 5 years or less loans. I've already talked about how raising interest rates can affect the economy and it can affect the stock market, so I'm not going to go too deep into that, but just understand this, that when interest rates go up, it becomes more expensive for businesses to operate, which could contribute to a slowing of the economy. And it also means that if you are an investor, say a venture capital investor, it becomes more expensive for you to borrow money, which makes it less attractive for you to go out and just invest into a company that isn't very profitable, because now you need bigger returns on your investments to justify borrowing. So you might see a potentially reduction in investment into startup companies, into businesses, because you need more kind of guaranteed returns to justify more borrowing. Think of it this way: if you can borrow $100 million at 3% a year, well, you only really need a 4% annual return on your money for you to justify borrowing $100 million at 3%. But if you can borrow the same $100 million at 8% a year, now you're going to need at least a 9% return on the $100 million for you to justify borrowing the $100 million. And if you cannot very comfortably get that 9% return on your money, you're not going to want to go out and borrow $100 million to make that investment. And this brings us to the government, which has something like $30 trillion worth of national debt, the biggest national debt that we've ever seen. And now, if the payments on this national debt start to go up, that means the government is going to have to spend more of their money to pay down their debt. Well, the government isn't a for-profit entity. They get their money from taxpayers, people like you and me. And so if the payments that the government has to pay go up, that means that more of the tax dollars that the government generates are going to have to go towards paying off this interest. Think of it like credit card debt, because you're going to see the exact same thing happen to credit card debt. Credit card debt is not fixed interest rate debt, it's variable interest rate debt, which means that now if you have monthly payments of $50 a month and interest rates really go up, your monthly payments on the same balance might go up to $75 a month. And so now you're going to have to spend more money to pay down your credit card debt every single month, even though you have the same balance, just because interest rates have gone up. That means more of your income is going to be used to pay down your credit card debt, and you can't use that income to now go out and eat at a restaurant because your credit card payments are higher. Well, in the government's case, it's pretty similar, because now the government gets their revenue from taxpayers. And their payments over the next couple of years are going to be going up, not just because they have more dollars borrowed, but because the interest rate on this debt is increasing. Remember, the government doesn't have a 30-year fixed rate loan. There's a lot of variable interest rates, and they're short-term debts, which means every few years they readjust, and so their payments start to go up. So if the government has more of their money going to pay down this debt and their expenses are not shrinking, because I can tell you that the government expenses are actually increasing, that means more dollars are going to be used to pay down the government's debt, and that means the government will have to issue more bonds or raise more money or find other streams of income in order to pay down this debt. Well, how can the government get more money if it's not just through borrowing more money? The alternative would be, well, raising taxes. That's one of the reasons why you've seen new proposals for the government to raise their taxes, because they need more money in order to pay off their expenses, and you're not seeing a reduction in spending. So the spending is going up and the costs are going up to pay down this debt, so the government's going to need more money. And so if you're not going to do it by cutting your spending, then you're going to have to raise this money by raising your tax revenue. And the real unfortunate part of that is, typically if you see increase in taxes, that you'd expect to see an increase in the value or services that you get. But in this case, the reason why the government would be forced to raise taxes is just though they have more money to pay down their debt. So it's raising money not for increased services, but in this case to pay down their debt payments, which is one of the issues that the government is dealing with right now. So let me tie it all together for you. The reason why the stock market became so inflated was because the Federal Reserve Bank created so much inflation through quantitative quantitative easing, money printing, and lower interest rates, which helped to stimulate and grow the economy. Now, this was good for the stock market, but very bad for inflation because all this money printing caused the value of the dollar to go down. And now with inflation getting out of hand, now the Federal Reserve Bank is having to undo some of their earlier policies, which means that they're going to have to tighten the monetary supply, and there is a cause and effect of tightening the monetary supply, and one of those effects is causing the stock market to potentially go down, because when it becomes so much more expensive to borrow money, so much more expensive to do business, then the stock value of these things also go down. That's one of the reasons why you have former Fed officials coming out and saying that in order for the Fed to really fight inflation, they're going to have to induce a stock market crash, because the stock market crash would be a side effect of raising interest rates and really fighting and reducing the size of their balance sheet. This is why you can expect to see a lot of volatility in the stock market, and this is why it really pays to be financially educated. That way you can make smarter decisions with your money. If you want to learn more about President Biden's new tax proposal and how this could potentially affect you and your taxes, I made a video covering that, and all you gotta do is click that button right over there. Thank you for watching, and as always, keep hustling. The reason why people love the idea of taxing big corporations like Google and Amazon and Apple is because they have these massive multi-billion-dollar profits